Well, hello and welcome to another virtual investor event hosted by NZX. My name is Doug Vrame. I'm with the Capital Markets Origination team here at the Exchange. Today we have three companies that have kindly taken the time to put some thoughts together, and we'll get you their story shortly. We have Stride Property Limited, Investore Property Limited, and Smartshares, and we'll get to them soon. But first, just a quick reminder of the format. It is 15 minutes from each speaker, followed by 5 minutes of Q&A. We really encourage you to ask questions, and to do that, you will use your webinar panel box and just hit the chat function and ask any question you have. Whatever we can't get to, we'll have the speakers answer, and we'll get them out later as well. There'll also be a video replay of this webinar we'll send out. And the last thing I'll mention is this is a disclaimer about this is for entertainment purposes only and doesn't constitute investment advice. So we'll get to it. We will start with Phillip Littlewood. Phillip is the CEO of Stride Property Limited and has overall responsibility for Stride. He joined it in 2014, has more than 20 years experience in property investment management in New Zealand and overseas. Highlights of his work history include 6 years in the UK, including with Morgan Stanley's real estate merchant banking division, partnership in large private equity real estate firms. So I will turn it over to you, Phillip.
Oh, hey, thanks, Doug, and thanks everyone for joining today. Hopefully you can see my screen. I assume all the tech's working. And look, today I'm going to talk a little bit about our strategy, tell you a little bit about Stride and who we are, some high-level investment metrics. I'll talk a little bit about our investment management business, which is a part of the business that is growing pretty rapidly for us. I'll touch on our portfolios and some of the recent activity that we've been working on there, and then I'll sort of finish up with a bit of looking ahead. Obviously, pretty interesting markets at the moment, so I'll comment a little bit on that, but again, happy to take any questions on that at the end, as Doug sort of suggested. So firstly, a little bit about who we are, Stride Property Group. So Stride's an investor, developer and manager of commercial real estate in New Zealand. We've got two main parts of our business. Firstly, we're a substantial investor in our own right. We own just under $2 billion Kiwi of real estate in New Zealand. And then secondly, we're a fund manager. So we are actually New Zealand's largest commercial real estate fund manager, and we're the only one on the NZX that has a focus on that particular part of the market. In terms of our people, we've got 110 investment specialists in New Zealand, and that's in 7 locations around the country. And we provide a sort of a full service, services for the investment management business. So anything you can think of related to real estate, really we do. So funds management, investment, transactions, asset management, property, facilities, leasing, capital management, health, safety, sustainability, literally anything you can think of. We have people within our business who sort of specialize in that area. In terms of our assets under management, so those are assets that we both own and manage. We've got about $3.8 billion of assets under management as at today on a sort of pro forma basis, and that's across 82 properties throughout New Zealand. And look, just a little bit about Stride as a listed entity, given this is an NZX presentation. So we listed on the exchange back in 2010. So that's just around 12 years ago now, and it delivered a 14% return per annum since listing. So look, we think that's pretty good, certainly for a sort of a low-risk real estate company like ourselves. Over the page, a bit about vision and strategy. Look, so our vision's pretty simple. It's to be New Zealand's leading real estate investment manager. By leading, we really mean the best performing. We think if we're the best performing investment manager for our investors, we will be by definition for our shareholders. And look, a key part of achieving that is through the development of our investment management business. So we're a long way down the road in the delivery of our strategy, but we also have quite a way to go. So it's sort of exciting and energizing, and certainly keeps us all highly motivated about what we're looking to achieve. We use our expertise to invest in and manage quality real estate portfolios that attract the highest demand and deliver the highest returns to our investors. Again, it's a sort of a self-fulfilling style investment philosophy. If we can deliver that, we'll attract more investors. And then on the right-hand side, we've got our pillars. They're the sort of four, we call them our 4 Ps. They're the 4 things that help sort of guide us and provide us with the sort of drive to deliver that strategy. So really simply, it's attracting and retaining the best people and investing and managing the best places will help us create the best products, which will deliver the best performance. So there's a lot more, within our business that we go into in that sort of detail, but that's a sort of a high-level summary of our pillars. I mentioned Stride's an investor or a significant investor in our own right. So here's a little summary of sort of what we own in our business. So firstly, we own $1.9 billion, just under $2 billion of real estate, either directly or indirectly, and I'll sort of come back to that in a moment. We're 98% occupied, and we have a weighted average lease term of about 7.3 years. So sort of you can think of it as sort of roughly taking us through to the end of this decade in terms of weighted average lease term. And we've got significant development pipeline. Development's a really important part of our business. Currently, we've got about 175 mil of pipeline. That's in addition to development, which we already have underway within the group. So plenty of growth to look forward to, which is obviously great. In terms of capital management, it's a really hot topic. It's always a hot topic, but I guess particularly at the moment with what we're seeing in the market. I guess the key point is Stride is an institutional investor. So we carry low leverage relative to, say, other investors. Our loan-to-value ratio on a look-through basis is 35%. And we also hedge our interest rate exposure pretty carefully. So the bottom right tile, you can see we're 98% hedged in terms of interest rate exposure at the moment. That falls progressively through the years. So in a couple of years' time, it'll be about 60%. But we have a very high level of cover for interest rates, which obviously, given what's going on in the market, is a pretty good place to be. Next page, some financial highlights. Lots of numbers on this page. I'll just talk to a couple. The first two we'll come back to in a moment around assets under management and management fee income. Probably the middle two are the ones I'll sort of highlight here. Stride's a property company, and one of the reasons people invest in property companies is for the dividends. So here is an example of sort of our numbers for last year. So we delivered a distributable profit per share. That's effectively the underlying cash earnings of the business of just under 11 cents per share, and we paid out 9.91. So we pay out most of our cash earnings. To give some context for that, that's around a 6% dividend payout based on the current share price. And given we're a listed pie, it's tax paid, so it means you don't have to pay any more tax as an investor on that dividend, which is it's obviously pretty advantageous. Other stuff on this page, look, our net tangible assets, it's the value of our equity was up 6% in the last year. So we've had a really good tidy run with our portfolio over the llast few years. Let's turn into our investment management business. So here's a way we sort of display our group by each of the products. So the one on the left-hand side is Stride. That's the assets we own directly. So I said we had 1.9 billion, about 1.2 of that are direct assets. And then on the right-hand side, the three to the right-hand side, those are our 3 existing investment management products. So the Investore, Diversified, and Stride. And Fabio's going to talk about Investor in just a moment, so I won't go into too much detail, but just some context in terms of our business. Each of the funds or products that we establish are specialists in certain sectors of the commercial real estate market. So in the case of Investore, it only invests in large format retail property. So that's Countdown, Bunnings, those sorts of assets. We own 19% of that $1.26 billion fund. That Stride owns 19%. The other two, Diversified, it specialises in retail shopping centres, $500 million fund, and we own 2% of that business. And then Industry invests in industrial property, logistics, those sorts of things. So just under $900 million now, and we own about half of that, about 51% of that business. So our strategy with these products is sort of twofold. One is to continue to grow the quality, the performance, and to attract new investors and ultimately grow the size of these existing products. So that's number one. And then number two is to establish more funds in other commercial property sectors. And office is certainly one that we have a bit of a focus on at the moment, but there are many others that we see able to be added to this sort of group or family, if you like, in the years to come. Over the page here, look, this is just another way of showing the growth. This is just over the past couple of years, showing the growth in our assets under management in the group. So we've grown $600 million in the past 12 months. That's about 20% by assets under management to 3.8 billion. On a pro forma basis, it's taken to account some pre-committed growth, 232, which you can probably see there near the top. So with that, and then the combination of the pipeline of development activity that we have within the group, we can see a pretty strong pathway to getting to $4 billion under the Stride Property Group. And to kind of give that some context, we set about this strategy about 7 years ago, so sort of a year after I joined, sort of Doug said earlier. And our business today is about 5 times the size of what it was sort of 7 years ago. So we have seen really strong growth in our AUM over that period of time. And scale is important for our business for a number of ways. Firstly, setting up a real estate fund management business is quite a cost-intensive business. It's cost-intensive to set up in terms of finding the assets and matching the capital with those assets and all the due diligence costs that come along with it. But it's also expensive to bring in the best people, which is part of our strategy, to help manage and grow those businesses. So, for us, it's about setting a certain level of scale to grow the business, to sort of hit all those high marks. And if we can achieve all of those things, then we will achieve a sustainable, profitable business for our shareholders. So that's sort of a really key part of how we grow and drive the business. Another chart just shows Stride's revenue and its diversity of revenue. It's probably a thing that a lot of people don't quite realise about us. We derive our income from 2 sources, from our direct investments and from our management business. And as I say, we are quite a diversified business. You can see on the bottom right-hand side the sectors where we receive our revenue percentages. And you can see it from a range of sources and a range of different sectors. And the second point I'd probably make here is that the management fee income does make up about just under a quarter, 22% of our business. It was about 1%, 6 or 7 years ago. So we have seen a really strong growth profile in that part of the business, and we continue to see that business taking a larger proportion of revenue going forward. So this is just a little bit more of a deep dive into the management fee income side of the business. And I think the chart on the right-hand side here shows the growth. You can see we've grown from $10 million in FY17. That was after the establishment of Investore and another fund, to $25 million last year. So, to put it in percentage terms, that's 250% growth, or 50% per annum on average. Over that period, and that growth is really highly correlated to the point I was making earlier about assets under management growth. So we're a really active manager. I think we're well known in the market for being an active manager, and we've grown our assets under management by 12% per annum over this period. So we've seen really meaningful growth in that part of the business, which has translated itself to effectively higher revenue and profitability for our management business. I'll go now to just some key, this isn't everything, this is just some key highlights of recent sort of portfolio activity within the group. And I'll start with office. Look, office has been a hot topic in the market and in the media. Obviously with COVID and working from home trends, there's been quite a high level of discussion and change going on. It's a really multifaceted topic. It's a sort of probably a presentation in its own right. Probably the thing I'd comment on is that I think there are some really important themes, at least in our minds, about what we're seeing in the office sector and how it will shape what the office sector in the future will look like. And so I've summarised those in terms of three ideas. The first one is sustainability. So sustainability, look, it's become a core part of our business in the last few years, but it's also become a core part of the businesses of our occupiers. And as a consequence, we've seen just a phenomenal increase in the demand from occupiers to be in high sustainably rated buildings. And so that's certainly driven a lot of the behaviour we've undertaken in terms of assets that we've bought or refurbished in recent times. It's sort of seen as not a nice to have, it's a need to have now. The second one is a move to higher quality buildings. So, we think that prime and A-grade buildings will outperform the broader market. And again, we're sort of seeing our behaviour move towards those sorts of assets. And then the third one is pretty topical. It's inflation in the construction part of the industry, higher development costs. And we have seen really significant growth in development costs particularly over the past 18 months. And we think that will drive cost push inflation for market rental growth for those new assets. If you want to be in a new building, you have to sort of effectively pay a rental equivalent to what it costs to build. So those themes have really shaped what we've done with our portfolio in recent years. Just pick out a couple of numbers. So in terms of the average age of the portfolio, we've brought that down from 36 years at 2020 down to 9.6 years. I think it's now one of the youngest portfolios on the NZX in our office portfolio. Our green assets, we've gone from 0 green assets only a couple of years ago to 75% of our portfolio being rated as a green asset. So that's certainly something we're very proud of. And in terms of the quality of the portfolio, 85% of our portfolio is now either grade A or prime. So we've really gone up the curve in terms of that quality level in the portfolio. So we think it's a much more fit for purpose portfolio for the future in the sort of post-COVID world. As I say, we could talk about sort of office all day, but I will keep going. Developments, as I said earlier, developments is a really important part of our business. It's important because we, as a full service investment manager, it's important for us to be able to create, establish and offer development style investments to our investors. It's a way in which we can differentiate ourselves from pure play investors. So it's something that we've spent a lot of time growing. We've got $130 million of committed projects at the moment. And we've got a great team. It's actually an award-winning team and a very experienced team. And I think if there's one discipline in real estate where you want an experienced team, it's in the development space. I think it really pays dividends, particularly when times are tougher. Maybe just the other quick point on this slide are the percentage of green projects. Again, that sustainability theme. Virtually every project that we do is green rated. Really, the only ones that are not, that sort of form that balance of that 100% are where it's sort of not practical to, like there's a seismic strengthening project in there. It's not really a sustainable project in the classical sort of sense. So pretty much everything is green, only when it's sort of impossible to not be. And it sort of leads me on to sustainability. As I say, huge part of our strategy, huge growing part of the market. It's the case for all NZX companies. Probably the point I'd make here is a couple of this. Firstly, we're quite engaged at an industry level. We do a lot of work with Property Council, Green Building Council. So we're trying to help shape the standards and behaviours that the whole market should be looking to employ. We think consistency is really important to be able to create comparability across assets. So we're doing a lot of work in that area. We're also doing a lot of work operationally with our business. So we've done our first climate risk assessment, and we've also presented this year our greenhouse gas inventory report, which is audited, and basically that sets the basis for our business going forward and how we can improve it. But look, as I say, it's a rapidly growing area in terms of progress and in terms of resourcing, but it's one that we are certainly fully committed to. So that sort of brings me a little bit to the end of my presentation. Just in terms of outlook, firstly, and will come as no surprise having heard this presentation, we're fully committed to our investment management strategy and continue to grow that part of the business. We do believe in that modern, high quality, modern green office property strategy. So we're certainly working on that one. We have more pipeline within our business to grow. We have that $232 million of committed growth. Should note it's pre-funded through our products and through our balance sheet. So we have capacity. And in fact, beyond that committed growth, we have a further 250 million of headroom. That's just across Investore and industry. So look, we feel really well placed at the moment. Maybe just a last comment, if I may, in terms of quite going for timing, just in terms of the market, because I think everyone will probably quite interested in what's going on at the moment at the macro level. obviously really high inflation, really high, or interest rates are starting to follow, not quite high yet. Just in terms of a property context, I think the old rule of thumb, if you talk to a sort of an old property professional, they'd say the rule of thumb is that real estate is a good hedge for inflation over the long term. Now, what we've seen in recent times is a rapid increase in inflation and interest rates rising as well. So we've sort of seen a re-rate as a consequence of those behaviours. In the direct market, if I can comment on that, we're still seeing transactions occur at the pricing that we've been at for the past few years. So that's, we sort of certainly find that interesting and supporting in terms of the activity. But we do think it will be slower and quieter during 2022 in terms of activity. I think by and large, most investors have very strong balance sheets and can manage through changes in the macro markets. But I suppose when these things sorts of happen, the things that I come back to are, look, what are the fundamentals of your business? Are you tidy? Is your shop in good order? And look, I come back to our business. We've got long leases. We've got quality portfolios. We've got leases that have links to growth in them. Many of our leases have CPI-linked rent reviews. Some have fixed reviews. Some have market reviews, and we're in the high quality end of the space. And we've got a capital management strategy which has been really effective. So we've got low debt and we've got lots of hedging. So we feel really well placed to manage the changes that are going on at the moment. But it's a really interesting time, and I think for the moment we'll be pretty prudent with our approach as we sort of wait and see how these next few months play out. But look, certainly over the long term, we are very excited and ambitious about our strategy to continue on with our investment management business. I think I might leave it there. I've probably taken up a little bit too much time, sorry. But Doug, should I hand back to you?
Yeah, thanks for that. That's great information, and what you touched on at the end about the kind of macro environments and rising interest rates and how that might have an effect was a big topic and a lot of questions. So thanks for getting into that. Another thing that kind of came up was about the green sustainable. And you mentioned you had 175 million of development pipeline, and a lot of that was going to kind of the green type space. What are there more demanding, I guess, cash requirements to maintain those properties than a typical property, or more difficulty in that?
No, and the technology is the building materials technology has improved out of sight. If you would ask me that question 5 years ago, I would say, yeah, there are some challenges and there's probably a bit of risk around some of that system. Look, we did New Zealand's first green rated building back in 5-star, I should say, back 15 years ago. So we've been doing it for a while, and I think there's a lot of learning out of it. It's been remarkable to see the whole industry upscale over the past couple of years. Project managers, architects, contractors, they're now all embedding sustainability in their practices, and I think there's been a lot of improvement in the areas. It's not quite the question, but the other kind of side to it is value. I talked about occupier demand, but there's also a value equation. I think we're seeing investors not wishing to buy non-sustainably rated assets. So there's also almost coming a bifurcation from an investment side as well. And the same goes for debt providers. We're starting to see the emergence of debt being cheaper if you've got highly sustainably rated assets. I mean, said another way, debt being more expensive if you don't. So as I said, it's not a nice to have anymore, it's a need to have. And I think we all agree it sort of had to happen.
Yep. I'll do one more question, then we'll hit you with some more questions on email and get them out to everyone. Yes. But given the rising rates and some of the I guess the concerns out there, and if you do have some dry powder, what kind of opportunities are you looking for going forward, and do you think there'll be a lot of them? Yeah, look,
cautious is firstly the word I'd use. There are assets that we are looking at right now, but there's not a lot. And as I said earlier, the market is a lot quieter than what we've seen in recent years. So you step back and you ask yourself, why is that the case? I think, if we compare it to, the last recession was a GFC, really a credit sort of catalyst for that recession, and balance sheets weren't in great shape. And so suddenly you had a lot of people looking to sort of fix their balance sheets by selling assets. This time around, it feels like balance sheets are in really good shape. We're not aware of a lot of people under stress. I think there will be some, but I think it will be a lot different to last time. And as a consequence, I think we'll just sort of see a lot lower level of activity. The areas where we are committing capital are typically into pre-let developments where we can manage the risk, fixed price contracts to high quality tenants and sustainably rated assets. Like if we can continue to improve the quality and location of our portfolio incrementally, I think that's really where we'll be focusing on, less so on the big bang stuff.
Awesome. Well, thank you very much. We really appreciate the time and you taking the time out to put some of that together, and it was very insightful. So thanks a lot, Phillip. And
that's cool. Thanks, my pleasure.
So now we will jump over to one of the companies Phil mentioned, which is Investore, and we have Fabio Pagano, who is a fund manager for Investore, and he will talk a little bit about some of the insights there. But just a little background on Fabio. Fabio is responsible for providing executive oversight and the focus on Investore's business and operations. He joined Stride in 2018 and brings over 15 years of international experience in retail management, which is the focus of the fund. His broad experience has given him expertise across all aspects of leasehold and freehold portfolios. Prior to joining Stride, Fabio held senior roles in the New Zealand government across property and infrastructure. So with that, Fabio, I will cut out here and turn it over to you.
Thank you, Doug. I'm just going to put my screen on. And hopefully everybody can see that. Thank you everybody for today. My name is Fabio. I'm the fund manager for Investore. And today I'd like to give you a bit of an insight into our business. As I talk through today, I'm going to show you a couple of examples of our assets, give you a bit of flavour for who we are and what Investore specialises in, a bit about our results and what we look forward to in the future. So just as I take you through, first of all, I want to touch on our strategy and some background to Investore for those of you who don't know us. And as I do, I want to show you some examples of our assets. So this one in particular is a countdown anchored property in Wellington in Newtown, a couple of specialty stores. It's a good example of our convenience offers. So on our Investore was listed in 2016, and we are the only listed property fund that focuses on large format retail properties. And we describe it as broadly supermarkets, hardware stores, and big box retail, for another word. There's a number of characteristics that we define large format retail. And these are typically types of buildings that are large, freestanding, single floor structures, very low life cycle maintenance costs, located in urban, fast growing communities, and have plenty of car park, as you would expect. Large format retail generally has high occupancy and certainty of income with long leases and manageable returns for our investors. As you heard from Phil, Investore is managed by Stride Investment Management Limited, and we have a fantastic and dedicated team that focuses on purely on our Investore business, along with our support from the wider organisation. And to date, I'm extremely proud of the way our team has navigated the last couple of years of COVID impact on retail and our business, and it also managed to grow our portfolio. When it was listed in 2016, we had funds under management, or value of our property was 641 million. And at the time of listing, and today, as of our last results at March, we are 1.2 billion. So a great result for us all. Just on our strategic pillars for Investore, we have 4 key strategic pillars that guide us in trying to maximise our returns and our distributions for our shareholders. Firstly, targeted growth, and I'll touch on that a bit later. It's focused on acquisitions and developments that deliver incremental return, looks at geographical locations and tenant profile, portfolio diversification that allows us to continue to grow and expand our business across New Zealand Secondly, we call it active portfolio management, and this is focused on owning properties in well-located areas, generally occupied by nationally recognised retailers such as Countdown, Mitre 10, Bunnings, and have a strong and enduring relationship with them. Thirdly is optimising our portfolio. This is taking some of our existing assets and the needs of our tenants and their customers and enhancing those opportunities. Some examples of those, we're doing a lot of work with Countdown, with the expansion of online pickup services across our network of stores in our portfolio, and other things like upgrading refurbishments, LED, sustainable lighting expansions across our hardware stores to date. And our fourth pillar, of course, is proactive capital management. This is an essential element of our business and means that we get to focus on maintaining a healthy and flexible balance sheet and for growth while preserving sustainable returns for our investors. And I'm just going to touch briefly on our recent results as of 31 March 2022 that we released back in May. And as I'll go through, there's another photo of one of our key assets. This is Bunnings and Tiered Upper in Hamilton, a great example of the growth in the hardware sector to date. Just on our results, some of the key metrics that we announced back in March. Large format retail remains really strong, and it was a really good year for us overall. Our portfolio grew to 1.2 billion, as I mentioned, and a valuation increase of 91 million, 8.2% over 12 months, which is a great result. We also delivered cash dividends of 7.9 cents per share, up 4.5 cents for the year. And on just to touch on another point, at the current share price, the dividend per share at 7.90 cents per share represents a cash yield of 5.45%. For our 33% taxpayer, it's equivalent of a gross yield of 8.13%, which is still a really good outcome for any one of our investors. Our loan to value ratio is great at 2.9%, and it's an important metric for us to make sure that we maintain a balance of capital and a balance of available funds in the future. We have a couple of committed projects, as Phil mentioned, about $50 million or so, and that would take us our loan to value ratio to 32.6%, at the lower end of our board's range, which is between 30 and 40%. And we have significant debt facilities that we will be able to use for the right opportunities if they present themselves over the coming year. And as we take a cautious approach with the current market, as we look at potential acquisitions or developments or expansion of our existing portfolio. Now I'll just take you through a bit about our portfolio of Investore, our large format retail. So this one here, the bottom one, is Bay Central Shopping Centre, which is a large format retail centre in Tauranga, anchored by Rebel, Briscoes, Hunting and Fishing, Lighting Direct, and a few others down there. And just about our portfolio, about our tenants. Investore is anchored by big box retail and the big national retailers you would expect. 86% of our portfolio under contract rent is by anchor tenants. As you can see on the left-hand side, 63% of our contracted rental comes from Countdown. So we are one of the largest Countdown owners of Countdown anchored properties in the country, one of their key relationship partners, and we also have a significant foothold in hardwares with Bunnings of 4 sites and Mitre 10, and also Pack and Saves, New Worlds, and a few others across the board. And on the right-hand side, just the type of tenants that occupy our properties. 73% is retailers that we define as everyday needs. So your supermarkets, your pet stores, your pharmacies, the things that you would possibly go to every day. And a lot of people on this call would probably visit one of our assets across the country throughout a week. I know I go to the supermarket and I go to the hardware store just about every week. And just looking at our broader portfolio, Investore's assets cover the breadth of New Zealand. We have properties from Kerry to Invercargill, We have adjusted our portfolio over the coming few years to focus on more high growth urban areas, with 84% of our portfolio now in the North Island and a huge 37% of properties within the Auckland region, and growth within the Bay of Plenty and Wellington as well, where we're chasing the demand of where people want to be for our properties and the customers of our retailers. And I want to take you through a little bit about, I mentioned earlier, one of our key strategic pillars is targeted growth. And I'll take you through a couple of key transactions over the last 12 months for Investore. Just this photo here, this is an example of some of the other activity we're doing within our business, is growing the online pickup services within our supermarket business, supermarket assets. This is a locker for online collections at one of our sites. These are being rolled out from everything from lockers to pickup services in your bays. So just an example of the growth in that online activity, but at a bricks and mortar store level that drives significant visitations to our properties. And just over targeted growth, some of the things have occurred in the last 12 months. We acquired a Countdown anchored property in Petone in Wellington for 37.3 million in May last year, a great convenience-based property. We also acquired a Rebel Briscoe anchored property for 36 million in Mount Roskill in Auckland. As you can see by this photo, it's adjacent to our existing Bunnings store, and creates a really good opportunity for us long-term with just over 3.8 hectares of highly desirable land in Auckland, in Mount Roskill, for future growth. We've done a few other opportunities where we like to add value to some of our existing properties, and looking at expansions. One of those is Highland Park in Auckland, where we're working collaboratively with our tenant Countdown to expand that offer, improve customer amenity, additional car parking, dedicated online pickup services. Our tenant Countdown will also undertake a full refurbishment of the store to offer an improved customer experience. Along with that, Investore receives a rentalised return for about $8 million worth of capital spend, and an extended lease term. So it works well for us and our tenant long term. Some of the growth in IPL since we have listing. This is a really good chart that shows how we have grown since listing in 2016. We have our portfolio through acquisitions and a couple of divestments, but our portfolio has grown in value by 12% per annum compounded rate since we listed up into FY 2022. Like for like, our portfolio rental growth continues to grow at 1.7%, which historically has been a really great result. And some of the acquisitions that we have acquired, driving incremental returns for our shareholders, is that properties that we acquired have grown rental growth about 2.7% versus some of the assets that we have disposed of over time at about 0.6% per annum. So trying to focus out and shift our portfolio to higher growth and improving and growing returns for our shareholders. And just wanted to also touch on capital management. In this photo, this is what I just mentioned before. This is the Rebel Briscoe in Mount Roskill. We bought this in last year. It was refurbished, and it's a great example of inner city LFR in a highly desirable location. And with one of our pillars of proactive capital management, Investore, as we are keenly aware of the rising rates environment, and accordingly we take quite a conservative approach to going forward. Currently, Investore is 100% debt is either fixed or subject to a fixed rate of interest. We have a weighted average maturity of 3.7 years, and we also undertook a bond earlier this year, which was a really good result for us, and making sure that we've got a really balanced profile for funding. And the mix of retail bonds together with traditional bank debt gives us the flexibility to look at opportunities as they will present hopefully present themselves in over the coming year or two more. And lastly, I want to touch on climate-related disclosures. It's quite interesting. This is the first time we've done this as a business, and we are keenly aware of our organisations and the wider groups of organisations' requirements for climate disclosures. This photo here is one of our assets. This is Mitre 10 Mega and Botany. We undertook an expansion with Mitre 10 for about $3 million worth of capital for a new garden centre back in 2019. Another good result, both us and the tenant on long-term leases, and by all accounts doing very well. And on climate-related disclosures, as this is our first year of doing reporting on the alignment to the task force, it is a bit of an exercise for all of us, but we've done a lot of work in terms of understanding how we manage our risk going forward. We've undertaken and completed inventory on greenhouse gases to calculate our Scope 1 and Scope 2. And we have chosen to look at greenhouse gases across the existing portfolio in a number of areas for FY23. As an initial step, we're also undertaking some further reviews of our existing portfolio. We're undertaking a Green Star assessment across two parts of our portfolio, our hardware assets and our single tenanted supermarkets this year. So those projects are underway and reviewing the Green Star performance of those assets. We're also undertaking our first GRES, which is the Global Real Estate Institute benchmarking exercise, which is underway as well to then set ourselves a target for the future. As we do that, we also look at a number of other initiatives with our tenants, such as EV chargers and potentially solar panel installation in a number of areas, but those works are underway in collaboration with our tenants. And then finally, just looking ahead, we look forward, investors well placed. I think it's a really demanding market where there is some really good, strong headwinds ahead of us, but there are some really good opportunities, I think, in a sector that has still a lot of appetite for supermarkets and hardware. It is quite volatile, so we are cautious. But as we look ahead, we've maintained guidance at 7.9 cents per share, which will give us a distribution of about between 90 to 100%, which is our policy. And I look forward to the future. So thank you very much, Doug.
Excellent. Thanks, Fabio. That was fantastic, and appreciate you putting those slides together. We did have a bunch of questions on some of the things that were similar to Phil in terms of valuations and interest rates, but I thought I'd tie maybe a couple together that you could talk to around. I guess you mentioned the opportunities, the volatility, and one of the questions is, with the increase of online shopping, do you see retailers or expect retailers to kind of decrease their physical presence? And in terms of the different retailers you work with, are there any that are, I guess, riskier or more reliable than others in that regard, as you kind of evaluate things?
I have that question a lot. So everyone's shopping online, everyone's doing pickups, but I think if I look at supermarkets, for example, our supermarket operators are expanding their presence, and we're working with them on a number of locations to expand their footprint, drive-through services, canopies. The online presence is getting bigger and better. We're focused on stores where, as a business, we have access to turnover sales. So that turnover activity is both online and bricks and mortar. And as it reaches a threshold, Investore can earn additional rental income from it. So if we work with them to drive that, then we will get a rental return in the future out of those activities. So that's where we're focused.
Awesome. Fabio, thank you very much. There are more questions. We're going to send them to you, and then we'll get them out, but really appreciate your time. And thanks again.
Pleasure. Thank you very much, everybody.
So now we will turn over to Stuart Miller. And Stuart, thanks for waiting patiently. I really appreciate you taking the time to chat with us. Just by means of introduction, Stuart is the Chief Investment Officer of Smartshares. Smartshares is a provider of ETFs on the NZX, and Stuart joined in that role in 2019 and is responsible for the oversight and management of a broad range of funds that Smartshares offers. Before he came to NZX, Stuart was head of diversified portfolio management at ANZ, and he has extensive experience in asset allocation, risk management, and overall investment strategy. So thanks again, Stuart, and I'll turn it over to you.
Great, thank you very much, Doug. Yes, good morning, everyone, and very pleased to be able to present to you all on Smartshares exchange traded funds. I believe Donna presented to you last year, and so I will cover some of the basics of exchange traded funds, which will be of value to some of you, and for others, I'll dig in a little bit deeper in this presentation, and really just trying to give you an opportunity to see how an institutional investor like ourselves and our super life funds and our diversified funds, we utilize ETFs and hopefully give you some insights into how a professional might use exchange traded funds, and with a view to yourselves being able to use them to give yourself really well diversified portfolios, as well as being able to add your own sort of flavor to those to your portfolio through individual security selections and active asset tilts. As Doug said, look, I'm Stuart Miller. I'm the Chief Investment Officer at Smartshares. Now, Smartshares is the manager of the Smartshares range of exchange traded funds. We're a wholly owned subsidiary of NZX, and we also manage the super life funds, which are unlisted funds that use the ETFs to get exposure to the markets. I'll come back to the range of funds that are available there just a little bit later on. But if I wanted to share some of the key highlights of Smartshares, we have grown quite considerably over the years. It originally established in 1996, so we've been around for a long time. And in fact, when the Smartshares exchange traded funds were launched back then, they were some of the few exchange traded funds available around the world. So certainly an early mover there, and we've got a lot of experience as an issuer of exchange traded funds. We're now at around about $7.8 billion, so becoming an increasingly significant fund manager here in New Zealand, and that has come with quite a bit of growth over the last few years, moving up around about 4.3 billion. A big chunk of that has come from an acquisition of the ASB Superannuation Master Trust. But in addition to that scheme, we manage Super Life KiwiSaver scheme, and probably a highlight there that I'd like to point out is that we were appointed as a default provider of KiwiSaver by MB, and so very pleased to be very privileged to be a default provider of funds for KiwiSaver investors. We also have a very large superannuation master trust, so that's our Super Life workplace savings. So we've got around about 3 billion there in funds under management, and look after 280 employer groups. The other point other piece I'd like to point out, so our Super Life Invest scheme is a voluntary scheme, so that can sit alongside of your KiwiSaver, and you can invest voluntary into either our diversified funds, age steps, and single sector funds that invest directly into some of the ETFs, and you can get that exposure on an unlisted basis. I'll come back to those final points there a little later. 1 second. So an exchange traded fund is a basket of investments. It gives you an opportunity to get a diversified exposure to a range of securities. The exchange traded fund is generally traded on exchange, as the name would suggest. But what that means is that you can buy or sell the exchange traded fund much like you can any single share listed on the NZX. You can track the performance of an index. So if you want to get exposure to the NZX 50 index, you can buy the New Zealand, our S&P NZX gross ETF, and you'll get the same return as that. And that ETF will hold all of those 50 securities in a proportional weight to track that index. not only can you sort of invest into a whole market, but we increasingly have subsets of markets that are available to you, so you can not only just build the core sort of asset allocations of a portfolio, but you can start to deviate out into various sectors. I hope that I'm trying to move a little piece away there, but that gets in the way. I hope you can't see that on your screen. I'm not sure exactly how to remove that, so I do apologise if that's getting in the way of the presentation. But look, the key advantage of ETFs is one, it gives you that diversification straight away. You can get a very cost-effective exposure to a lot of all of the stocks in the ETF without having to go and buy each one to get that diversified exposure to a particular market or sector that you're after. An ETF is a single tax, so tax at 28 cents in the dollar pie, and that comes imputed. So imputed imputation credits can come through in the form of a special dividend. So if you're on a lower tax rate, then you can claim that back. It's the ETFs really give you that core part of that foundation, and we have 35 ETFs available, and you're able to buy those ETFs through your broker just in the same way as I said before, as a single security. So it kind of fits quite nicely alongside either building your own portfolio using securities, and or getting exposure to various markets and switching that out for those security active picks that you might be after. From a super life perspective, when you think about how we, our philosophy and process around managing diversified portfolios, so that's where we utilize the ETFs to build a diversified portfolio with multiple asset classes, and so that's funds that you might be familiar with through, say, KiwiSaver, from conservative, balanced, and growth, or whether they're age steps models. But essentially, we believe that most markets are relatively efficient, by asset class. So what I mean there is, if you're looking at the New Zealand market, there's 50 securities. It's very difficult to actively pick a portfolio that's going to beat the benchmark. Now, that's not to say that some very good managers out there can do that, but nonetheless, it's very tricky to do. And sometimes just getting that exposure to that asset class is the most important piece. When you think about the performance of one portfolio for one investor versus another investor, the biggest determinant of the difference in returns really comes from the asset allocation. So, that's largely saying, is your portfolio, what weight of your portfolio is invested into equities, what's invested into bonds within that portfolio, to what degree you're applying some hedging, how much cash do you have in that portfolio, and so for example, and then other markets like property, for example, and those are going to be the biggest determinant of the difference in returns between portfolios. And if you're thinking about risk in your portfolio, so if you want to dial up or down your risk, doing that with asset classes and doing that in just spreading your diversification across various asset classes that will perform differently in different parts of the investment cycle, that is the easiest and cheapest way to be able to manage your risk. So by adding bonds or cash, you can de-risk your portfolio quite quickly, and that can be certainly a lot cheaper than and probably easier to do than looking at hedging type strategies, utilizing futures options and things like that. So at Smartshares, we offer a very strong range of ETFs now. The ETFs here that we've got listed and highlighted in yellow are what we call our core ETFs. They're the building blocks that you need just to build a basic diversified portfolio. Those funds just purely track the market cap weighted benchmarks largely, and that's what an institutional investor will manage their a diversified fund to. So a balanced fund might have a different mix of these types of indexes, and then they'll go and pick the securities or get that exposure through an ETF or through a different fund. But outside of the core ETFs that we've got available, you can see there. So in New Zealand, we've got mid caps. We've got an ETF that tracks the dividend index if you're looking for a little bit more yield. And we've got ETFs that might track the property market. So you can get your exposure to property and then complement that with some individual properties exposures, maybe Stride Property Group that we've just had presenting. And then, more recently, we've been adding some ESG options. So for investors that want to make sure that they're not investing into some of those, companies that they consider to be not very environmental or have sort of low sort of social, who have some sort of social exclusions and or better governance. Those have some exclusions in them. We're increasingly expanding that range. And also we've got some thematic exposures. So automation and robotics is a theme that has some longer run tailwinds, and healthcare innovation is also a very attractive way to get some growth into your portfolio and do that in a very diversified way. Some of those ETFs, while they're targeting a specific theme, they still have up to 100 companies. And those ETFs, or the index provider of which those ETFs track, utilizes AI to determine what sort of revenue streams that come from those particular themes, and that allows them to pick those companies and build a portfolio for you that you can buy on market in one trade. So I'll just back up a little bit and go back to what I was saying before about how a professional investor might build a portfolio. First of all, they'll think about their what indexes they want to track and what asset classes and what mix of those asset classes they need. They want to be diversified, so they want to have both New Zealand equities and New Zealand bonds, because we are New Zealand-based investors. So and it's nice to be able to invest into some local companies. But they'll certainly want to make sure that they have some global exposure. The New Zealand market is relatively small, and you can get some global equity exposure through, for example, here we've added the ESG ETF as an example, but you can also get an exposure to the global aggregate bond ETF, which gives you exposure to the global aggregate bond index. And again, with one trade. I think there's over 20,000 securities in that index, and it's a very good way to get exposure to multiple global government bond markets. So you're diversified by region and country, but also to multiple corporate bonds across various regions, industries, sectors. Very broad, diversified exposure there into bonds. And increasingly, bonds are increasingly attractive with yields much higher at the moment. So, that's a good way to get that exposure in your portfolio if you haven't had that before, and if you want to de-risk some of the equity that you might have in your exposure. So those are the core exposures, and if you have a look at some of those ETFs that we have those at very low fees, and I think you can build a 60-40 portfolio at around sort of 30 basis points or so. In cost. So it's a very, very cost-effective way to get that core strategic asset allocation, and then you can build around that. The next level is, once you've got your core portfolio, you can actually use ETFs to apply some tilts. So like I pointed out before, in the New Zealand market, you might sell a little bit of your NZX Top 50 ETF and diversify into some property. So using the NZ Property ETF. And if you like the New Zealand market, but you probably want to have your portfolio tilted towards high yielding type securities, then you can use the New Zealand dividend ETF to get that exposure. And then as far as offshore markets, we've seen quite a big sell-off in some of the small caps markets in the US. Emerging markets have performed poorly. But if you think they're starting to represent some value, then you might target the small caps in the US and utilize the small cap ETF for that. Same for emerging markets, but in this case we're showing that we want to tilt that towards ESG, and that emerging markets ETF does have some of those exclusions that you may see as valuable in your portfolio. We've also got the Smartshares New Zealand Cash ETF there, which often people sort of wonder why would you have cash ETF, but that's a portfolio of a very diversified portfolio of term deposits across various banks, CDs and bank deposits, but that provides a bit of liquidity in your portfolio. So if you see an opportunity, it's a great way. You can sell that ETF and go and buy, for example, some global bonds through the global aggregate bond ETF. You can do that with the same T+2 settlement, and it matches off quite perfectly. So you can switch out of cash into bonds or into equity if you think that they represent value. So you can change your tilts in your portfolio quite quickly depending on what your view is around markets. And that's exactly the same as what a professional investor might do in a diversified portfolio to add value over time actively. So this is giving you just a snapshot of, say, the New Zealand top 10 ETFs. So these are the largest by market cap weighted stocks on the NZX. So if you want to get a very high level, broad exposure to some of those bigger names, some of those blue chip companies, you can do that with one trade. And so we've given you some characteristics there just to give you an understanding of that portfolio, a 2.25% dividend yield. But more importantly, you can see exactly what stocks are in here. And if you're just starting to get some exposure to the New Zealand market, just buying the top 10 ETF gets you started. You're diversified, and then you can spend a bit of time doing some research. And if you decide that, look, Auckland International Airport represents some good value, and is likely to deliver some good returns going forward, then what you might do is sell around about 10% of your top 10 ETF in your portfolio, and put in some Auckland Airport, which would increase the weight in your portfolio overall, and then you can also add some other stock picks. But by doing that, you continue to maintain a properly diversified portfolio. Whereas if you hadn't invested in the New Zealand market before and you go out and buy Auckland Airport, you're going to be 100% exposed to Auckland International Airport. So the top 10 ETF is a great way to kind of complete that asset class for you while you build up individual stock picks and do your research, and then you can gradually sell that down over time. Institutional investors will do that as well. So they might have a portfolio of 30 stocks. They'll sell. They don't want to hold one of those securities, and they'll replace it. But they might not have a better buy idea at that point in time, and they might sell Fisher & Paykel Healthcare and go and buy themselves an ETF just to cover that position for a short period of time, and then they do a bit of research and they decide that Spark's a good place to put some money, and then they'll go and sell that ETF and go and buy Spark. So it's a valuable use of an ETF in your portfolios. So how do you get exposure to those ETFs? Firstly, you can go directly to Smartshares website. So we've got, that's www.smartshares.co.nz, and you can see all the ETFs that we have there. You can sign up and sign up to a regular investment plan, or just do a bulk purchase. Or if you'd like to get some advice around building your portfolio, and also buy some other securities at the same time, it's always worth either going to a broker or an advisor for that and forming a relationship on that front. They can give you access to the Smartshares ETFs as well to complement your portfolio of securities. A lot of the platforms like Sharesies, Invest Now, Flint Wealth, they have available the Smartshares ETFs. You can obviously use an online broker. And also, I touched on this earlier, our unlisted funds, so our super life schemes use ETFs, and we build those diversified portfolios for you within our super life diversified fund range, or you can build your own asset allocation by investing into the super life single sector funds that invest one for one into the Smartshares ETF. So it is a sort of a slightly indirect way of getting exposure to the ETFs, but a very convenient way that you can do that by going to our Super Life website and joining up there as a member, either through KiwiSaver, use like your KiwiSaver scheme. You can manage your own portfolio using those. By using those single sector single sector funds to get exposure to the ETFs, or just invest into the diversified funds. So we've got the KiwiSaver scheme, workplace savings, if you're with an employer that uses Superlife, and also the Superlife Invest, where you can have money outside of your KiwiSaver or your workplace savings that is voluntary, and you can draw down on that at any stage, but you can invest that in the exact same funds that you use within your KiwiSaver. I'll probably already sort of talked to this slide already, so I won't go into any more detail, and possibly move forward to the to questions. So back over to you there, Doug.
Yeah, thanks, Stuart. That's actually really awesome information. Thanks again for putting that together, especially about, I think people think about ETFs as being very passive, but kind of describing the way you can use them as an active investor to make sector bets and tilts is very interesting. There are many questions. We're running a little over as we got off to kind of a late start, but the big one seems to be around themes and opportunistic, I guess, sectors. And will Smartshares add new ETFs in the future? And what are some of the emerging themes that you guys are looking at, if any are jumping out at you?
Yeah, I think a lot of the interest is really coming through either ESG, or we've currently got the ESG, which has exclusions, but SRI, so funds that actually tilt portfolios away from ESG risks, as well as having exclusions. And so it's sort of integrating responsible investing into the portfolio to a greater degree, and doing that in a way that the portfolio actually gets tilted towards more sustainable investments, so it has an investment sort of thesis in behind it as well. So that's good. Some of the thematic pieces that can be good. There's quite a wide range of opportunities out there, but again, it's sort of into the sustainability side of things that seems to be of the most interest. Probably just at a like a diversified level, within our diversified funds, we're sort of looking at markets where they've sold off considerably, and I might have touched on this earlier, but bond yields are looking a little bit more attractive, and for a while we've been holding quite a lot of cash on concern that bond yields were too low, and that the market was underestimating the pace at which central banks could raise rates if inflation proved to be a little bit more sustained. And so we were holding more cash, but now that now that bond yields are looking a lot more attractive, we're starting to tilt that just gently back towards some bonds in the portfolio. We don't need some of the inflation hedges that we had in before as well. And equally, equities are looking a little more attractive in terms of valuation, notwithstanding the fact that maybe there's a little more in this cycle to run. So, those are some of the tilts that we're applying and using ETFs to get those exposures.
Nice. And last question was just kind of came up a few times that you mentioned. So, how active are ETF investors? It sounds like more active than one might think. So you talked about the institutions that will use ETFs if they can't find a buy opportunity they like. Do you see that with retail investors as well, kind of making these changes and tilts and being more active than people typically associate with an ETF portfolio?
Yeah, that's right. It's a very big trend, that we've seen offshore for some time, and you can see that with the amount of sort of flows that have gone into passive tools. A lot of that's through exchange traded funds to be able to get a passive exposure to a particular market, but using those building blocks in an active way, and by either actively allocating, or firstly building your core of your portfolio, actively allocating, using various ETFs, but then also making some active stock picks, and using the ETFs to complete that asset class. So maintaining their, managing their risk by using ETFs.
Yeah.
So.
Yeah, very interesting. And we'll leave it there. We're 10 past 12, but there are more questions. We'll get them to you. Everyone that's listening will get them out to you with some answers along with the link to the recording if you do want to watch this again, or if you jumped in late. But I wanted to thank everyone for taking the time to join us on the Virtual Investor webinar or event, and also thank the presenters, Stride, Investore, and Stuart from Smartshares. So thank you, everyone, and we'll be hopefully doing another one of these soon. Thanks again.